Have you ever seen people online talking about buying a stock or getting excited about a company like Tesla going up in price? Have you ever wondered what they're actually buying? Today, we're going to explain stocks in a simple way: what they are, how they work, and why people care so much about them. So what is a stock, really? In simple words, a stock is a small piece of ownership in a company. When you buy a stock, you actually own a tiny part of that business. That's kind of amazing when you think about it. Here's an easy way to picture it. Imagine your favorite company is like a big pizza cut into many slices. Each slice is called a share. When you buy a share, you're basically saying, give me one slice of this company. For example, let's say a company is split into 10 total shares, and you own 5 of them. That means you actually own half the company. In real life, big companies have millions of shares, so your slice would usually be much smaller. But the idea works the same way, no matter how big the company is. You might be asking, why would a company want to sell little pieces of itself to random people? Good question. Companies sell shares mainly to raise money. Building and growing a business costs a lot. They might need money to build new locations, create new products, expand into new places, or simply keep the business running. Instead of going to a bank and borrowing money they'd have to pay back with interest, they can sell parts of the company instead. That money is theirs to keep and use. No repayment needed. Let's walk through a simple story to make this clearer. Imagine someone named Ria who dreams of opening her own coffee shop. She figures out she needs $100,000 to get it started. The problem is, she only has $50,000 saved. Instead of taking out a loan, she decides to split her business idea into 10 equal shares. Since she's putting in $50,000 herself, she keeps 5 shares. Each share is worth $10,000. Then she sells the other 5 shares to people who believe in her idea. One of those people is a guy named Sam who loves coffee and thinks Ria's shop could really do well. He buys 1 share for $10,000, which means he now owns 10% of the coffee shop. With money from Sam and a few other investors, Ria finally has the full $100,000 and opens her coffee shop. Fast forward 5 years later, and the coffee shop is doing amazing. Ria has opened 3 more locations, and the business that started out worth $100,000 is now worth $300,000. Remember Sam, who put in $10,000 for his 1 share? His 10% is now worth $30,000. If he sold it today, he'd walk away with a $20,000 profit. But investing doesn't always go this well. Let's say instead, the coffee shop struggled against bigger competitors, and the business value dropped down to $80,000. In that case, Sam's share would only be worth $8,000, meaning he actually lost $2,000 of his original investment. This is basically how stocks work in real life, just on a much bigger scale with much bigger companies. Some companies also share part of their profits directly with shareholders. This is called a dividend, and it's basically a small reward just for being an owner of the company. So, where does someone actually go to buy these little pieces of a company? They go to something called a stock exchange. Think of it like a marketplace built just for buying and selling shares. The 2 most well-known ones are the New York Stock Exchange and the Nasdaq. Nowadays, you don't have to go anywhere in person. Most people just buy stocks straight from an app on their phone. Once a company grows big enough, it may decide to go public, meaning it lists its shares on one of these exchanges so that anyone can buy or sell them. Now, here's something important. Not all stocks are exactly the same. There are usually 2 main types: common stock and preferred stock. You can think of them like 2 different types of tickets to the same concert. Both get you in, but with different perks. Let's start with common stock. This is the type most people think of when they hear the word stock. When you own common stock, you get voting rights. That means you can vote on important company decisions and help choose the people who run the company. 1 share equals 1 vote. 1,000 shares equals 1,000 votes. You might get dividends too, but they're not guaranteed. If the company has a bad year, they might not pay anything out at all. The upside is that common stock usually has the highest potential to grow in value over time. The downside is more risk. If the company ever goes bankrupt, common stockholders are the very last people to get paid, sometimes getting nothing at all. Now let's look at preferred stock. Think of this as the more cautious, responsible version of common stock. People who own preferred stock usually don't get voting rights. In exchange, they get something valuable, guaranteed guaranteed dividends. Preferred stockholders get paid before common stockholders, and those payments are usually steady and predictable. If the company goes bankrupt, preferred stockholders also get paid before common stockholders, though still after anyone the company owes actual debt to. You can think of preferred stock as sitting in the middle between regular stocks and bonds, less risky than common stock, but usually with less growth potential too. So which one is better? It really depends on what you want. If you're chasing bigger growth and you're okay with more risk, common stock might fit you better. If you'd rather have steady, predictable income with less drama, preferred stock might be more your style. Why would anyone put their money into stocks instead of just keeping it safe in a bank? Simple: the potential for growth. A regular bank account might give you around 1 to 2% a year. Stocks, on average, have historically returned somewhere around 7 to 10% a year over long periods of time. Of course, that extra growth comes with more risk. The stock market can move up and down a lot, kind of like a roller coaster. Some people invest for the long run, hoping their companies grow steadily over many years. Others try to make faster profits by buying and selling more, often based on short-term price changes. So there you have it. Stocks explained in simple terms. When you buy a stock, you're not just buying some random number that moves up and down on a screen. You're actually buying a real piece of a real business. If you're thinking about getting started, it's usually smart to begin with companies you actually understand and believe in, and to avoid putting all your money into just one stock. Spreading it out protects you if one investment doesn't work out the way you hoped.